Welcome to the Explainer. Today we're diving into a huge, and I mean huge, shift happening in the world of AI. We're going to move past all the talk about chips and code and get down to the one thing that AI absolutely cannot survive without: raw physical power. So let's start with this quote because it really just sets the entire stage. The idea here is that the whole story of 2025, the AI gold rush, that's over. A new game has started: the electricity rush. And that last part is a pretty serious warning, suggesting that the narrative we all got used to, the one about GPUs and AI models, it's not just old, it's becoming a trap. A new, much more fundamental trend is taking its place, and it's all about the physical electricity grid. So here's how we're going to break this all down. First, we'll take a quick look back at that AI gold rush. Then we'll poke around and see if a bubble might be forming. After that, and this is key, we're gonna uncover the hidden energy crisis that's threatening to stop this whole revolution in its tracks. That leads us right into the electricity rush, and finally, we'll explore what it actually means to invest in this new reality. All right, first things first, let's do a quick recap of the incredible AI boom that pretty much defined the last couple of years. This will set the stage for the massive pivot we're about to get into. The undisputed king of this whole era was NVIDIA. No question. Their chips became the modern-day picks and shovels for this digital gold rush. The demand was just so insane that it shot the company's value into the stratosphere, for a moment there, making it the most valuable company on the entire planet. And what was feeding this frenzy? Well, it was what looked like completely unstoppable growth from the AI model companies themselves. You had OpenAI, Anthropic, all of them posting these just jaw-dropping revenue numbers. And of course, that just created even more demand for computing power and, yep, more demand for NVIDIA's chips. But, whenever the excitement gets this high, some people start to ask that really important question. Is this incredible rise actually sustainable? Or are we just watching a massive bubble get bigger and bigger? And this is the crucial part. The valuations, they were stretched to their absolute breaking point. I mean, you had companies trading at over 100 times their annual sales. When you see numbers like that, Wall Street calls it priced for perfection. And that means there is absolutely zero room for any error, any disappointment whatsoever. Now, this is where we pull back the curtain a little bit on some of the financial gymnastics that were going on behind the scenes. This shows a circular financing loop, and here's how it works. A tech giant, say, invests a bunch of money into a hot new startup. Then, that startup turns right around and uses that exact same money to buy cloud services from the tech giant. See what's happening? On the books, it looks like brand new revenue, but it's really just the company paying itself. This can seriously inflate growth numbers and make it hard to see what the real organic demand actually is. And this chart, wow, this really puts the concern into perspective. What you're looking at is IT investment as a chunk of the entire economy. And it's right back at the same peak it hit just before the dot-com bust. Now, this kind of historical parallel is exactly why some analysts are using phrases like extreme bubble. The point isn't that AI isn't a huge deal, it is, but that the hype and the valuations might have gotten way, way ahead of reality. Okay, so all of that brings us to the real wall, the physical limit that all the money in Silicon Valley can't just wish away. This is where the story takes a hard turn. And that really is the $1,000,000 or maybe $1,000,000,000 question, right? You can print money to fund startups. You can finance massive chip orders. But what you can't do is just print an electrical grid. Get this. A single ChatGPT query uses almost 10 times the electricity of a normal Google search. Now, multiply that by billions and billions of queries. The real bottleneck here isn't digital, it's physical, and its name is energy. I mean, just to wrap your head around the scale of this problem, look at this number. This is the power that just one company is planning to use for its data centers. That's the same amount of power you'd get from 26 nuclear power plants. This is not some small uptick in demand. It is a tsunami of new load hitting our power infrastructure. And here's the brutal truth. You can't just decide to build a nuclear power plant, or any giant power project, and have it running next year. Between all the planning, the permits, the regulatory reviews, the actual construction, you are looking at a 10-year timeline minimum. AI innovates in months. Building the power to support it takes over a decade. That is a very, very dangerous mismatch. And this mismatch creates this terrifying new investment risk they're calling stranded capital. It's the very real danger of spending hundreds of billions of dollars on these incredible state-of-the-art data centers, filling them with the best chips money can buy, only to find out there isn't enough electricity to flip the switch. They just sit there, dark and useless.
So, this huge energy crisis that's on the horizon, it's setting the stage for the great infrastructure pivot. The AI gold rush is winding down, and the electricity rush is just getting started.
This sentence right here, it seems so simple, but it is incredibly powerful. It completely shifts our focus. It's not just about making the power anymore. It's about the critical and, frankly, often ignored infrastructure that gets that power from the plant to the data center. We're talking about the grid itself. And the grid is the one piece of this whole puzzle that has absolutely no substitute. This just shatters a huge myth about AI. We love to think of it as this purely digital thing that lives in the cloud, right? Weightless. But the truth is, AI is a business of atoms. Its success is completely chained to physical, real-world things. Power grids, massive amounts of water for cooling, lands to build on, and the specialized crews to actually build these things. And if you need any more proof, look at what the tech giants themselves are doing. We're seeing some really shocking moves. Microsoft didn't just go sign a normal power contract. No, they are helping bring a nuclear power plant back to life. Think about that. When a software company has to get into the nuclear energy business, you know a fundamental shift is underway. Okay, so if the whole game is changing, if it's shifting from software to physical infrastructure, the big question is, how does an investor even begin to adapt to this new world? Well, the whole picks and shovels idea for AI isn't just about chip makers anymore. The new playbook is all about the entire physical supply chain for electricity. It starts with power generation. We're talking utilities, nuclear providers, and even new tech, like small modular reactors, or SMRs, which a lot of people see as a key part of the solution. Then you've got power transmission, the companies that physically build and upgrade the grid. And finally, power management, the specialists in cooling, networking, and actually getting all that power deployed inside the data centers. And this means you have to look past the usual big tech names to find the real enablers, the industrial and utility companies that are the backbone of this whole build-out. So we're talking about specialists in cooling systems, networking hardware, and construction. Now, for broader exposure, people are looking at ETFs. But here's the brutal truth. A lot of the green energy ETFs are full of residential solar companies, which is not at all what these giant data centers need. The smart money is focusing on industrial scale power and the specific ETFs that target the grid itself. So here you have it, the whole pivot in a nutshell. The 2025 strategy was a bet on AI models and chips using broad tech funds. The 2026 and beyond play is a bet on energy and the grid, focusing on very specific infrastructure and utility funds. The entire investment thesis is shifting from the digital world to the physical one. And that leaves us with this one final, really provocative thought. For the last few years, the entire race has been about who can build the biggest, smartest AI model. But as we look forward, the most important question is changing. It's not about who has the best algorithm anymore. It's about who has enough power to actually keep their algorithms running, who can keep the lights on. That, right there, is the infrastructure pivot.